So how does this work on the buildings, on real estate? How does it work when you go buy a house? Welcome back here to our short-term rental loophole series, and now we are going to be talking about depreciation, and within that we're also going to talk about something called detailed invoicing. But this is key to understanding. This video we're going to talk about the standard depreciation, straight line stuff. In the follow-up video next, we're going to talk about bonus depreciation. So start here if you need the basics of depreciation and understanding that, because it's going to tell you that. Also, this is going to have some great information on detailed invoicing and how we may be able to not have to depreciate it at all. We can just expense it at times. So let's dive in here on understanding depreciation. If a business or real estate investor goes and purchases something that is over $2,500 and it has a life of more than a year, it is likely going to be considered a fixed asset. And what that means is that it doesn't go directly on your P&L. It doesn't go directly on your income statement. It doesn't go to an expense. It's not like insurance or your tax prep fees or whatever it is. It goes onto your balance sheet as an asset. They're looking at that as you have an asset, right? You have a vehicle, equipment, whatever it is, but you set that up as an asset. And then you will depreciate it. And all of these assets fall into different lives. So if you go get a tractor, it's going to have a 5-year life. Meaning if that was $10,000, you're dividing it over 5 and taking $2,500 a year as an expense. In 5 years, it's down to 0. The reason for depreciation is that the IRS in general takes the stance that everything you buy goes down in value over time. Right? So they don't want to let you just expense this right away because you're going to have it for a little bit of time. You're going to get the use out of it. So what they do is they say, okay, yes, you have that tractor for $10,000, but it's going to go down a little bit over time. If you tried to sell that in 3 years, it's going to be worth less money. So they're trying to match up the sale price with your basis. Like they're trying to let you expense it along the way so that if you sell it in year 3 for $5,000 and you've taken $4,000 of depreciation, they're close to where the sale equals like what you've got in the actual asset. So what you have the asset on your books for. Now, obviously that doesn't happen. It's far off, especially when it comes to real estate, because they're allowing you to depreciate buildings and depreciate this stuff. And over time, it historically goes up in value and appreciates. So that's where capital gains are created. And if it goes down too low, that's where capital losses are created. But what you need to understand is that anything over $2,500 with more than a 1-year life, it's very likely going to be set up as a fixed asset and depreciated. Everything goes into a different class or category. It all has a category by the IRS that says this is how long it should be classified. So let's look at, you go put in $10,000 of flooring, right? You get a contractor, he puts in $10,000 of flooring. Normally you'd be like, well, I just want to take that $10,000 in flooring and expense it right away. It's repairs. Problem is they're going to say, no, that flooring is a 5-year life. So $10,000 goes on your balance sheet as furniture, equipment, flooring, that into that category, the 5-year stuff, and divide it over 5 years and you get $2,000 a year. So every year you move $2,000 onto your P&L as another expense item, right? So that's how basic depreciation is going to work. So after year 1 or year 2, it's down to $8,000 on you have an asset worth $8,000 because you've expensed $2,000 of it. Now, before we get more into this, let's talk about detailed invoicing because this can be key. So talk with your GC, talk with your contractors about making sure they are giving you good invoices, right? So if you get an invoice, let's say the contractor comes in and he gives you an invoice, one line item, general work that we did $10,000. Well, if what he did was installed 5 windows, right? And he installed flooring and whatever else he did. If he breaks that out differently, if he gives you a new invoice that shows, and you give that invoice to your account, and that invoice shows, okay, we installed 5 windows. The cost of that was $5,000, which included the cost of the window and installation. And then we installed the flooring, that was $5,000. Well, now you can take that invoice and right away you could say, all right, $5,000 for 5 windows, that was $1,000 per window. Those are each under the $2,500 de minimis level, and we can expense that right away. We can take that as a repair, right? So we put that directly on the P&L, and that is always, or not always, from a tax play, that's usually going to be the best opportunity for a lot of people. So great, we put that over there. Now we're looking at $5,000 of flooring. What can we do with that? Well, unfortunately, the flooring, it's over $2,500. It is a 5-year asset, so we need to set that up and we need to look into it. And now we can get into depreciation, and then you can get into using the bonus depreciation on it. But first and foremost, figure out what it is you can actually expense right away, because the majority of the time expensing ends up being better. Now, there are some other considerations, especially when it comes to financing and making sure you're bankable and things like that you want to keep in mind outside of the tax world. But that is, in general, from a tax play, expensing is usually king. There's timing issues and other things too, but expensing we're usually looking at first if we can. Then we're looking at bonus depreciation, and then worst case, we're looking at regular straight line depreciation after that. So how does this work on the buildings, on real estate? How does it work when you go buy a house? If you've been in the industry, if you know a little bit, I've heard a little bit, you've probably heard that you can't take bonus depreciation on rental properties, right? You can't take it on the building. You can't take it on some things that go on the building, like a new roof and everything like that. And that is true. So let's just break down, because it works a little differently on the building, and you're going to need to understand that in order to understand bonus depreciation and in order to understand cost segregations. So if you get a building, if it's a long-term rental, it has a life of 27 and a half years. If it's a short-term rental or a commercial property, it has a life of 39 years, right? So if you go get a $500,000 property, let's just say it's a short-term rental, $500,000. First, we have to break off land. So we'll figure up what the market value of land is, and there is a way to do that. And if your accountant is just using, it's 10% or 20%, that is not a way to do it. They need to actually get the market rate. Like, they have to go figure it out. Land is different values for every property and everywhere, right? Land in Florida and California is much different than land in Missouri or Indiana oftentimes. So we need to figure out what the land value is. So let's use the example 500,000. Let's say 100 goes to land and 400 goes to the building. Land will never be depreciated. So the way the IRS looks at it is, land doesn't go down in value. There's nothing, it's land. It's always going to be there. So they don't depreciate it. It's not like you're using it up and making the land worse. So land stays on your books at $100,000. You will never get to expense that. It will hold up, and when you go sell, if you have capital gains or 1031 considerations, the land is at your value there. But the building, the 400,000, you're going to divide over 39 years. So now we're looking at about $10,250 a year of depreciation from that building. So every year you're gonna move 10,250 over. Now in year one, if it gets set up like in October, you're probably talking about closer to like $2,800, right? Because it's by the date that it's placed in service. So if you place it in service in October of year one, you're gonna get 3 months. So take 10,250, divide it by 12 times 3, you get 3 months of depreciation. In year two, then we're going to 10,250. Year 2, year 3, year 4, like as long as you hold it. That final year, year 40, really, because it's after 39, like you're going to get another short year, 9 months of depreciation if you hold it the whole time. But by the end of that year, that property is going to be down to $0 on your books other than the land of 100,000. So that's how depreciation works. That's how it works on the building. That's how it can work on furniture, flooring, things like that. But again, that's straight line depreciation. It can just in general create some losses for you, oftentimes should. But worst case, it's reducing your rental income, potentially eliminating rental income, likely creating some losses. And then from there, that's when you're going to start to look into bonus depreciation. And from there, you're going to look into cost segregation. So follow along. Next video, we're diving into bonus depreciation.